Thank you, Professor. Thank you. Well, thank you, Professor. We're going to give about a minute to transition over, but let me know in the meantime how you're doing and what you're thinking. And I'm going to walk you through the post-Fed. I'm kind of with the professor here and with Gianni with respect to it's not what the Fed does, it's what happens the next day. In last night's video, this is specifically, and we'll go through this, but this is specifically the game in the event. We're just playing if thens. We're not playing, hee hee ha ha hindsight. We're playing what happened before, what was the preparation, what was the planning, what's the outcome. And again, most importantly, what's the trade? So we're going to play that out and see where we are in the big picture, which still is bullish. Really, really don't have. And the target last night was the expected move. So again, there's so much to go over in today's session. Got day done on the actually long side. This is our trade in the futures room just a few minutes ago. Again, no hee hee ha ha hindsight, live, real time, real money trades. Number one, shorting the expected move, which was, I'm just doing the intro right now. See, we're going to talk a whole bunch of swing logic. So 6-3-17 was your expected move. And that wound up being, hey, Rosario, good to see you, the high of the day. But the lesson from the intraday chart, I always talk about the live trades we did, just from a lesson standpoint. The expected move, this is one of those things you scratch your head on. You're like, wait a minute. That just happened? Like, I'm this dude here that pulled out a number out of thin air. Okay, it's not thin air, but of all the people in the world, hundreds of thousands of people that trade, I wrote a number in the report yesterday and the market hit it. I don't know about y'all, but that's pretty cool. And then just because I'm not a one hit wonder type stuff, did it again today. Oh my goodness. Oh my goodness. This stuff matters. It matters. It's the Tony Corey type price, bias out the window, if then targets and price performance, and then putting trades on with that logic. So anyway, got ahead of myself, but the futures room trade was actually long off the 95, played up to the 10, and wound up getting another 10 handle move for us in the futures account with scalps or similar type trades. But I don't think I want to talk futures too much right now because there's so much more going on in the market. And I'm with the professor. I always turn to Professor Bierman when it comes to the quarterly earnings and hedge fund managers and quant fund managers and what they're doing. He has a pulse on what those managers and fund, I say behaviors, but the behavior, the buying and the selling, the hedging and the like of the money managers. He's got insight into that world, and he's very good to share that with us. And I always appreciate his insights. And he is of the assessment that we're going to keep going up. I think Gianni is of that assessment just by virtue of how we speak to each other and trade and look at our sessions. But I am bullish not because I am a bull, but because the evidence favors the long side and continues to do so. And that's where we are on the big picture. The evidence is bullish. The fundamentals are, not quite as bullish as they used to be, but the price chart is. And until we start seeing deteriorations, breakdowns, and mainly for me, I'm looking for the moving average of the price to be under that 50 moving average, which is down here. Until that happens, it's just bull. Sounds weird, right? It's just bull. No, it's bullish. And we want to tilt the chart, tilt the profile, tilt the intraday chart, and tilt our swing accounts to the upside. We do not want to be contrarian. We don't want to be against this unless you are very professional and you're managing risk. Again, that's understandable. But being as this is not something that is unique to 2025. And that's kind of what we want to do as traders is be quantitative. And how are we quantitative? Professor Bierman, myself, and Brandon have charter market technicians designations. What is that? We had to read a whole bunch of books and take a bunch of quizzes and take a bunch of had to get sponsored, and a lot of things went into obtaining that very prestigious charter market technician designation. Not a lot of people have it. TheoTRADE, you have three of us that have that designation, which is pretty cool. But one of the things they will tell you is that trends are identified as a series or sequence of higher highs and higher lows. Professor Bierman takes it a step beyond that and talks about linear regression. I like to look at moving averages. And again, Johnny has targets. I think Blake and others have targets too. But if we quantify what an uptrend is, it becomes a series of higher price highs and higher price lows over time. We can add, again, linear regression, which is going up. We can add the price is above the 20 exponential. The 20 exponential is above the 50 exponential. We do trades off of that, by the way. And the 50 exponential is above the 200. That is a quantifiable way to define a trend. And we can quantify that, again, through 2023, 24. That was a bear market, went the downside. We can quantify a downtrend. Right? We quantify downtrends just the same way. But 2021 was an uptrend, higher highs, higher lows, rising moving averages. Of course, that was COVID, but even before COVID, also an uptrend structure. 2027 is when I first joined TheoTRADE. That's an uptrend structure. We're not talking about the Fed. We're not talking about inflation. We're not talking about geopolitics and things like that. We are talking about quantitative price analysis, which is nerdy, but it matters more than just banging out bear trades every single day because you don't like it or don't want it or don't feel like or feel that this can't go any higher. Quantitative analysis tells you that it can and probably will and has been doing so since the last few months. So if you are up against, if you're putting your opinion, which I've done, we've all done it, nothing wrong, not pointing fingers. I am in this position as an instructor because I've done everything in the book, bad and good. So I've been where you are thinking this can't go any higher. It just has to come down, but it doesn't. So again, this is just, it's models. It's not, I think, I feel, I hope, I wish, I don't want. It seems like you can even go back well beyond 2017. The same logic. Again, quantification of higher highs, higher lows, quantification of rising linear regression, quantification of rising average. Again, price above the 20, 20 above the 50, 50 above the 200. We build a quantitative model, which is nerdy, but it matters, of an uptrend. And once we build that quantitative model, we can just put, plug and play. That was a pretty good little downtrend. Downtrends are just as valid as uptrends, right? But we're not using our opinion to quantify. We're using models and mathematics. And this right here in 2025 is similar to what gold is doing. And gold is similarly quantitatively uptrending, right? We might not have the same feelings or emotions. Stocks are, we might actually be very, very bullish of gold and making money in gold, but it's not different. What about GE? Ah, GE, we've had trades off of that. Most recently, a couple trades long GE because we've quantified it and other stocks like it as uptrending. And when a stock is uptrending, it tends to keep trending, and that's going to give us advantages or trades. Again, it's everything has to come out of trades, right? No theory, no feelings, no emotion. We've got to put trades on. And so if a stock is trending, it probably keeps trending. And if it probably keeps trending, there's two things that we want to try to do. Number one, well, goal ultimately, it's the hard part, right? Join the trend. Join the trend. Come on in. The water's fine. Join the trend. Well, how? If a trend is a series of higher highs, higher lows, rising moving averages, rising linear regression, if a model of a trend looks like this, well, what the heck do you want to do? You want to try to step into the market when it's pulling back, when it's hitting a support shelf or doing a higher low. You don't know that's going to happen, but that's what the goal is. Join it when it pulls back to something, a support shelf, a moving average, a Fibonacci, a linear regression, a price level, a support shelf or something like that to enter, to target, and I think the target's just the prior high. Whoa. So target and a stop or a risk. And that stop is going to be under those moving averages. And that becomes a model about how to enter a trending stock with good risk control, good probability, and good edge. Now, again, Gianni, Blake, and others will execute trades getting into positions on a break to new high. Is that wrong? No. Why is it not wrong? Because that's what the trend model would suggest. But again, I am a short-term little in, out, done. So my rules for engaging trending stocks or trending markets are going to be buy when a stock or an ETF retraces or trends. See, there's no trade here. I know, I know, I know, I know. This is where trending stuff can be very difficult because there is no trades here. None. Not even here. Right. But the first trade you get is here. And the target becomes here, and the stop or the exit price is down here. This becomes your risk. Right? Professor Bierman is very good to remind us about how important risk is, which means we will lose money. Right? The call will be less valuable to the extent the price goes under support. But, if the market, if the model, if the price goes off to make a new high, that becomes the reward. So I don't know. This puts it into a probability, puts it into a risk reward, and it puts it into a specific trade. Entry at the average, exit at the high, or hold beyond it, and risk under. And if you miss it, I miss stuff. I don't get every trade. I miss way more trades than I take. But the rule is there. Sometimes you have a little bit longer to get the trades off. Sometimes you have one day. And if you're on a 1 minute chart, which is what we trade the futures room, you only have, a few moments to do so. But that's what we are doing on a 1 minute chart, on a 5 minute chart, and on a daily chart. So if we are trending, if the price is above, and we come back to a moving average, this is your risk. This is your reward. And the market can be a little squirrely, but that's what we did in the futures room. That was our trade of the day. If you did not short the upper expected move, and the trade was similar in the whoa, uh, long buy off the 56.55 in the Russell. I'm kind of kicking myself for not holding that thing a little bit longer. All righty then. Okay, way back in the questions. By the way, that was my introduction. I gotta greet y'all. Okay, back in the chat. Marshall, hey buddy, good to say hey Marshall. Hey Tim. Peter. YouTubers are. Hey Twain. Hey Twain, I love good to see you. Hey Rick. Rick says green so far. How old's the picture banner page? What do you mean? How old's the picture? Probably like 3 or 4 years, honestly. Uh how old's the picture on the banner page? I'd say 2022. I'm wearing context there. You got a problem with how I look? Does it matter with how I look? Are you going to make money or lose money based on how I look? And yeah. So Stefan got it. Yeah, yeah. So again, I don't want to talk too much about the expected move because I'll get off in futures land. But Stefan said he went ahead and shorted the expected move and got the day made off of that. A lot of people did this morning. No, I was bearish for a little bit more than that. Just to be clear, my track record. Um, I do not have, this is not mean. It's just having done this for as long as I've done it. I do not, I shouldn't say anything. Mama said, don't say stuff that, if you don't got something nice to say, don't say it at all. So I'm just going to listen to my mama. Not going to say anything at all. So, but no, Twain said you were bearish 50 minutes. I was a little bit more than 15 minutes. I can tell you exactly when I threw the bull towel in. Um, was over when Walmart had that little thing. There was Target, some retail sales. Essentially, the consumer fell apart. So we had to change pretty quickly as a trader. I had to change as an analyst, and I did this. So follow the data, not the bias, is where I was hinting at. Never be a bull 24/7. Never be a bear 24/7. I mean, let the market tell you what to do. So I had to change when retail sales, when we had the tariffs were in the news. What else? Geopolitics, some Middle East flare-ups were happening, and things weren't necessarily new administration. There's some bullishness to it, obviously, but the consumer just literally fell out of bed in early February. So I very quickly had to bang the drum of the short side. So I was short, bear, selling, bear. Actually, was a bear market. I remain bear here. I remain bear here. I went short here. That was my last short. It was supposed to work. This is just talking about how we adapt. I was playing puts unapologetically. Market's going to make new lows, bear market, downtrend. Again, we don't have hindsight. We just have this, right? Lower low, lower high, bear flag, short, short, short. I did it too. But the market is the ultimate arbiter, and we have to change with the trends. So trends are lower lows, lower highs. When a trend reverses, it goes, higher high, higher low, lower high. The trend reverses. We need to reverse with the trend and be bearish in the new trend. Okay, well, the trend reversed over here. So again, I played puts. I got bloodied. Most of y'all probably did too. I was right there with you. Bang! And I sat there and licked my wounds until that day right there. And that day right there, pretty much, I can tell you when I went bearish right here, when I went bullish right there. But again, I'm a trend person. I tend to play in the direction of trends. If the trend is down, there is no hindsight. We're going to play bearishly until the trend is reversed. And once it got reversed, y'all remember how bullish I got buying the pullbacks and advocating off the long side and giving all my commentary on the buy the pullback and be bullish type structure. So I don't get them right all the time either. And I'm a little bit late to parties, but when you're a trend follower, that's the good and the bad. You're going to be late to reversals. You're going to get caught up in a few things that get you. But I would rather be, this is my opinion, not everybody else's, but this is my opinion. Take it for what it's worth here, right? May not be worth anything. But I would rather be somebody who went in the direction of the trend and was wrong a little bit, right? So, oops. So, correct. Ding, 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 ding. Wrong. What is that, like 9-1? I'd rather have a 9-1 win-loss ratio type thing as opposed to short, oop, short, oop, short, oop, short, short, oop. Again, that's my opinion, but I'd rather be somebody getting hit on the reversal as opposed to somebody calling for a reversal and having a win rate of 1-9. The problem is they celebrate and say, look at me, I'm, Sandra D when they call the top type stuff. But anyway, that's my opinion. Certainly something I have done in my career, trying to call tops and bottoms. I no longer do that. And for new traders, I am very adamant that new and developing traders not try to call tops and bottoms. Don't do it. It's very destructive. It's very, I'm speaking from my experience, not anybody else's, but it's just very draining. It's very frustrating, and it just, you're missing out on the what I would call obvious, or what becomes obvious once you see it from a different perspective. And that would include stocks like Nvidia, which is bullish. I think Meta about back to the high in Meta, right? Anybody short Meta, you're getting squeezed out in the bull flag, right? The Google, the what else we got going on? I think Intel to an extent, right? Intel buy off the dip. Palantir going back to the highs. Anyway, so in TheoTRADE, what I'm doing is trying to identify one of two conditions. I'm going to pull it back. Condition one, that's a one, Roman numeral, range. So condition one, range. A ranging stock is going to look like Disney. So Disney is going to fall in the category one, range. A lot about the CVX. It's going to be category range. ExxonMobil. We have a lot of stocks actually. XLE energy sector. The category is range. And we will trade range stocks by shorting range highs. Again, we're going to have to talk about executions, entries, exits, targets, and buying going long range lows. So we want to be bullish off support, boom, boom, bearish off resistance. And you can differ. Some people are a little more bold. I'm conservative. I'm very conservative. But I will target, remember your entry, your target, and your risk or your stop. So when the market's at the high of a resistance, which again, different trades we've had up here, and that's a pretty good one. It doesn't always work that way, but you'd be shorting up against 64 or 84, sorry, 84, 94, good Lord, glasses, 94, real-time targets about 84, and I just say done. And once we get long, and anyway, that's how we trade ranging stocks. So what would be something we do not want to do in a range type environment? Some people faded me and they paid the price for it. Because I, most recent trade in Starbucks, was short. I, with y'all, played puts in Starbucks up here. Why did I do that? I love coffee. I got a full, coffee here. I love coffee. But I am shorting Starbucks because I have quantified it in a model of a trading range. I'm going to play puts on it. The risk is that it breaks. Obviously, very real risk. The reward is that it goes back to the middle. So there's always people that are trying to make a name for themselves. I had a couple of emails like, oh, you're short. I'm long Starbucks. Oh, I don't know what's going to happen. Neither does that person. But we can't predict the future, but we can be very specific with, again, quantification. So if the price is, say, 110 and the target's 95, what are the odds that A, it shoots up? Well, it's real. It's a very real potential that Starbucks or something like it can just go, and that's my risk. I will lose. That put would have gone kaput had Starbucks broken out. But my risk is the other person's reward. That's what they want to happen. They want the market to break out, and they will benefit if it does. That's why I like the calls and the puts, right? I've got a put, you've got a call. Bring it on, right? Nobody knows what's going to happen, but we can absolutely quantify probability. So the model would suggest we go back to the middle. And that would be roughly anywhere from 68% to maybe 75% chance of success, meaning from here to here. Entry, target, risk. The person who's going long on the breakout, essentially at the highs of a top of a range, has at best 32% chance of success. Now, you think that's good odds. It's not terrible, but it's probably closer to 25. So, right? Odds are odds and probability. There's no prediction here. I am taking a specific trade with a specific risk with a probability close to 70%. Somebody else is going long, taking a similar trade with a probability close to 30. Well, the market got the middle. And that's the same way we want to think about buying the dip or trading flags or things like that. We want to be careful, be patient. Again, don't throw the baby out with the bathwater. People that were short this trade were playing the game with me. Also emailed, frustrated, like, what do I do? The market's going up. I'm like, oh. Again, I love to show this example because it's real, right? This is kind of a long here, right? It's real because we took it and people had a similar trade. They were short. Some people got stopped out. They got frustrated. They got scared. Some people got long. And in the end, the model wound up working. The model says high to mid, but it wasn't without a little bit of frustration. So again, that's the real world of trading, why the puts, why the calls, why the call spreads, why the put spreads, Don's type methodology would be superior than just going, short and oops, it went a dollar against me, right? And that's going to be true on the intraday basis as well, right? Because the expected move, I think, was a 14, wasn't it? 13. The market went a little bit above the expected move and then crashed back down. So I love that concept of calls and puts and call spreads and put spreads because it gives you a little wiggle room and flexibility when the market sort of, pokes or probes or goes a little bit too much. You're going to be a little bit taken care of. Okay. Back in the chat. Hey, Raj Bro, good to see you. Peter. Well, in the grand scheme of things, that's actually a good question. Hold on. Peter has a good question. This is actually a really good question. So when I'm looking at stocks, hold just one second here. I want to highlight this question because it all comes down to trader, right? And goal, and ultimately rules, and therefore strategy, trading plan, a business plan, that kind of thing. The market's this big old animal. It's a big old beast, right? The market's huge, right? Trillions of dollars slosh up and down the market every single day, right? But what do you do with that? You got to be specific. And I think that trading to me, just kind of swing intraday, all that stuff comes down to Mark Douglas. What is that? Trading in the zone. And and then there's a whole bunch of lessons from that. But what's the main lesson? The market is a river. So there's always stuff to do. You got what, 7, 8 instructors. We're all giving you trades. Some of us, Tony and myself, are giving you, tons of trades on an intraday basis. You're like, you're too quick. You don't pay attention. That's okay. Trust me, you don't all have traded intraday. But professors giving you longer term trades. I think Johnny as well, maybe Blake and Don and Brandon, they give you longer term trades. So you may hold a position with them 6 months, and maybe with Brandon you might hold it for a year. Maybe Professor as well, maybe Don as well. Well, that's not my world. I don't do long term stuff. So there's the fundamentals, there's the trend, but there's weeklies, dailies. In fact, there's monthlies for that matter. Hourlies, 30s, 5 minutes, 1 minute, and I think Blake goes down to tick charts. So you could have a very bullish monthly, very bullish weekly, very bullish daily, but you could be at the top of a profile, bearish here, maybe a 5 minute chart. So what's the point? The point is you can't do it all. I can't do it all. We have to specialize. Trading is this broad thing about, so much you can do. But you pick, and what Mark Douglas talks about, if it's a river constantly flowing, you pick when to enter, how long to stay, and when to exit. Now, again, that could be something on a very short-term basis. It could be a monthly basis. It could be a weekly. What you do not want to do is look at everything all at once. What is that? What's that movie? Everything all at once, right? Something like that, right? Everything everywhere all at once, whatever that thing was. You don't want to do that. Why not? Well, the monthlies are very, 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 and one more very, very bullish. The weeklies are pretty bullish. The dailies are pretty bullish, although I'd say a little bit short-term bear. But the volume profile has us bearish. See? And the 15-minute chart, you sort of see where I'm going there. So the 1 minute chart has us bull bear back, bear here, bull here, right? It's just, what's the point? You got to pick. You got to be responsible, and you got to limit your activities. If you're a swing trader, there's obviously instructors that do well with that. If you're an intraday trader, there's futures room and instructors that do well with that, and other traders in the room that are very, very, very good at scalping equity futures back and forth, long here, short here. And ultimately, if that's all you're doing, with all due respect, what does it matter? Does it matter? Do you even care what the monthly chart is if all you do is scalp back and forth equity futures? No. Does it matter what the weeklies are? Obviously, the reverse is true. If you're a retirement trader or investor and you're holding things for 2 or 3 years, what significance is it to you whatsoever about a 1 minute chart? See, but you don't want to get confused. And a lot of traders get confused with the concept of time frame. I'm throwing out nerd words at y'all today. I'm sorry. Relativity errors. Time frame relativity errors. Well, there's a divergence on the 1 minute chart, and I really want to get long. And Tony's going to go long, and Corey's going to go long, but I don't know. But the volume profile's bearish. Gosh, we're just so overextended on the monthlies. Oh man, the weeklies are doing this, and so you wind up, hands are tied, and you do nothing. You shouldn't be looking over here if you're going to scalp a 1 minute chart, right? Not relevant to you whatsoever. Okay. Anyway, goal. The purpose of that is we can't know it all. We can't do it all. We can't trade it all. And the goal is to limit, to be specific, to be intentional, and to put trades on in markets, in ETFs, in stocks, in futures, in commodities, in things that make sense to options and so on and so forth. You're exactly in the right place. You're in the right place in TheoTRADE, right? We got you covered, but you can't do it all, right? You can't do it all. At least if you can, I can. I can't do it. Linear I'm back. Rick said linear age regression. I wish that were the case. Man, I'm 45. I got started trading them when I was like 18 or something. So, all right. Hey, Peter. Yeah, Frankie. See, again, Frankie saying bear flag, Tim saying bull flag. Again, Tim is very good. Frankie's very good. All y'all very good. But just to kind of highlight the point, I'm looking back in chat of time frame relativity errors. Frankie said bull flag, or sorry, Frankie said bear flag. Tim's like bear flag. What are you talking about? The market has ultimately not bear flag. We are not looking for bear flags in a trending market. Um, I get it, but it's a little bit more bullish on the Russell. Oh, sorry. Frankie corrected him. I'm reading the chat live real time. Frankie's like, no. I wrote the wrong term. I meant to say bull flag. And that's what Tim was like, what are you talking about? Right? You're trying to do a bear flag off of that? Just by definition. Frankie's like, no. I wrote the wrong word. So, in fact, that was a trade in the futures room. It was long right there. Yep, that's the facts. Yeah, for sure. So Frankie said, okay, yeah. Can I give you the script? Yes, if I can find it. Where can I find it? Give me one moment. And take this time. Any he's like, don't worry, don't get mad at me. It was a mistake. No. Yeah, we want to be intentional, and we don't want to be looking at bear flags and a trend. Frankie knows that. Just for reference, right? We want to be quantitative and very very intentional. So do not look for bear flags in a bull market. Do not look for bull flags. Frankie knows that. He typed the wrong word, but just to be clear, that's what Tim's like, huh? Spidey sense went up there. But again, we're being intentional, we're being specific, and we're being fact based, rule based, method based, model based, quantitative, as opposed to thinking or feeling or I want to find a bear flag so bad. Why do I keep doing that? I want my bear flag. There's no bear flag. Not right now. Okay, I'm trying to show you this. Where the heck am I doing this? My 5 minute, 1 minute chart's right here. I don't know if I can copy it because I don't know if I can do that. You this way. No. Ah. Okay, right there. Yeah, ideally in the next mastermind should be coming up soon. So any questions? Again, there's a lot to talk about. We have about 30 minutes left. Questions? So I'm going to kind of pause. But any questions as we look at these stocks at all-time highs? Do you have any kind of halfway point in my presentation in my session today? Questions, comments, thoughts, ideas, things I can help with. Again, if left to my own devices, I'll sit here and well, that's what I do is answer the questions. My number one goal is to make sure y'all are taken care of, your needs are being met, and you're being, you know, given good information. So that's why I'm very much in the chat and very much chat centric. Correct. So Ramesh, hey, yeah, Ramesh, can you go over expected move? Yes, absolutely. We'll be happy to do that. So the logic behind expect move. Don and I taught a class, and I learned expect to move from Don. So we you can teach an old dog new tricks. I learned this from Don, right? From and I just took it and ran with it because it's huge on the intraday chart. Expect to move was kind of a secret sauce or secret key that unlocked a lot of my struggles. You know, why does a trend day all of a sudden go bleh, right? And the answer is expect to move. So Don taught that to me a couple years ago. So what we're trying to calculate is the closing value and what the volatility or what the market says. What does the market, this is not, hindsight stuff, it's forward looking. What does the stock market tell us about volatility for the next day? And there's a lot of ways to calculate that. We're trying to figure out an upper and a lower bound of volatility. And let me underscore why this matters before I start babbling about math. I'll try to keep it simple, but I have trouble being simple because I like being a nerd. Because y'all are nerds, right? Y'all get this stuff. Y'all are very smart. So let's go back to Tuesday. Keep in mind, how do I say this too? When I'm doing my sessions, particularly futures room sessions, right there with the Tony and crew, price. So amount of words. Think of like a little graph or something, right? Amount of words. I don't, whatever. So, well, the Fed's going to do this, and this is going to happen, and that's going to affect interest rates, and 2 hours later, 2 hours later, you've said all these words in analysis, right? These are 5,000 words. Maybe I'll say 50 words, but in the 5,000 words, do you have a specific price target? Do you have a turning point? Do you have, rules, and how do you build rules? Well, the expected move is a really, really good way to build live, real-time, real money trades on the intraday basis. You can pretty much use this as a standalone system. What I am not doing is babbling for 5 hours about what the market's going to do tomorrow. What I am doing is coming up with a very specific number. And it works in all markets there. But again, the Fed day, the Fed day, the Fed day. And the number I came up with, or the market came up with, I'll explain the method, 6615. In fact, I thought, bear reversal from this to that. So I can babble endlessly about words about what I think the Fed's going to do, what's going to happen, and what's going to happen, what's going to happen. Or I can be like 6615, the lower bound, and 6721, the upper bound. In fact, the midpoint's the target there, right? Take me about 50 words to say the probability is the market's going from here to here. And once it gets that, it can easily come up the other way. And same would be true here, right? In other words, the expected move can be a target to play for and a reversal point. In other words, it's a standalone type of system. And it goes with the profile, right? But so you need to know that the number with 50 words or fewer, 6615, in fact, maybe even 6620. Why am I showing you that? Because with all the stuff that happened, that was the low of the day. Huh. Hmm. So if you've never heard the expected move, you're like, what is this? It's an extremely powerful thing for real money, live trades, and live decisions. You're like, okay, that was a one-off. Corey had a magic number, pulled it out of the thin air, and 6, 6, 15, and okay, well, I mean, pretty good. But 6, 7, 13, bull short squeeze above that, up to the 6, 6, 6, 80, 6, 7, 0. So I gave you 6, 7, 13. Also, it could have been the downside, right? It's both equal. 6, 7, 13 is the number I gave you last night. Well, I love to say this with Tim because I joke about this. I'm going to have to resign TheoTRADE. I'm going to have to quit because my number was not perfect. I told you 6, 7, 13. The high was 6, 7, 18. I'm sorry. Love being here, but I'm wrong. I'm sorry. And I'm just, whatever. Okay, I'm being funny, being silly. I wouldn't leave y'all if I had to. But people who went short against that, the rule is to short the expected move. Now, why are we talking expected moves? Because we're using the market to tell us I mean, it's on the nose, right? And Don does this very, very proficiently with butterflies and many, many, many ways to trade expected moves, right? Plenty of ways to trade this. Don is very, very, very top notch on this as well. The market told us the expected move was a potential play for 45 handles, and dag nabbit, that is what happened. Dag nabbit. So instead of predicting and thinking and babbling for 5 hours, let's ask the market what the expected move is for tomorrow. And how do we calculate that? We take the closing value of the S&P. So here's go back to it. Take the closing value of the S&P futures. Same for the Russell and the Nasdaq. So I've got your attention about why it's so important amongst all the people in the financial media. I called out the low of the SPX yesterday and the high of the SPX yesterday. Am I a magician? No. I learned that from Don. And so it's something you can learn too. I had to learn it myself, right? Don taught me and everybody here in TheoTRADE. So take the closing value of the SPX, or sorry, closing value of the ES or the Nasdaq or the Russell. We're talking S&P. Take the closing value at the bell. Bing, 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 bing. And then we go over here and look at the SPX. And from the SPX, we calculate the expected move. And the expected move is that number. It's not 16, it's 48. So we look at the one, not the AM settlement, look at the one. So whatever that one is going to be when it closes, right, at the closing bell once again. So I would write down the closing value of the S&P futures and the expected move for tomorrow, add it. That's what it says, right? Add and subtract. We're going to add it and we're going to subtract it. And that becomes a game plan. And that's what we're looking to do for the trades. So I won't play this, but I also have the video. So not just the expected move, the written game plan. Do I have that there? Is that the wrong one? 1 second. 1 second. That's Tuesday. Sorry, my bad. Game plan for. I'll go one back, I say, for Wednesday. So what we're trying to do as best we can with swing trades and with intraday trades, now obviously I'm much more intraday, is try to get a sense about where the market's going before it gets there. I know that sounds hard, but that's what we're trying to do. And what I'm advocating here and discussing here, this is in the video. So what I'm just repeating, if the market's above 6,680, this is last night's video. So let me, actually, can I play that? Hold on, let me get this in there so I can play that right there. The upper expected move, 6,713. Okay, might not be able to hear it. Hold on. If the market breaks above that 6,680, 6,685, you'll see the upper expected move, 6,713, maybe even higher than that on a short squeeze. which puts us on the intraday bullish pathway in the event the market's above, let's say 6685, 6700, and especially above 6713. Not in the cards from the expected move necessarily to go well above that 6720, but stranger things have happened, and we are traders. This report is not a forecast into the future. It is simply game planning out tomorrow. Well, so TheoTRADE, every one of you had the number in advance. What you gonna do about it, right? You do not make money on forecast and predictions. You make money on live real-time trades. So the way the expected move plays for me as an intraday trader, this is in the class, by the way. If the EM is here, Don does this as well. If the price, say, the close is here, the open is here, and the expected move is here, well, we call that a drive, or I call it a drive. I call it play number one is called go get it. Go get it like a dog, right? Go get it. Go get it. Which means the market has play, right? First 30 minutes, 60 minutes, that type of thing. There is play, therefore live real trades to go get it. And once we get it, once we're at the expected move, it is a good play. And Don does this very well to play puts or scalp Tony Corey type futures or play micros or sell short shares and different little ways to trade for the reversal. So to me, there are two intraday specific ways to use the expected move. Number one, if you're here, to quote a Tony discussion, you're going to here. Well, that happened pretty quickly. Kind of hard to get into the trades there, honestly, but it did. So if you're here, you're going to here, right? If you're here, the expected move is here. We call it a drive. So try to play bullishly Tony levels or moving averages or Corey type stuff to go get it. And once you get it, again, the market's told you this much and no further. 45, specifically 6713. This much and no more. A little bit more, right? Now we have the divergence. Now you want to play Don type of intraday puts, Corey type of intraday, share positions, Tony and Corey, or Blake for that matter, type of intraday future scalps. There was a trader in the futures room that played if I'm not mistaken, she played a short call vertical. You're like, what the heck is that? Well, she knows the expected move. She doesn't want to go necessarily long volatility. She went short volatility and shorted a call. Made money, closed at 50%. Now, not something I would do because I want to get directional, right? I don't want to play spreads intraday necessarily, but that was an effective move to book handles or to get money ultimately. So anyway, that's if you're like, what the heck is he talking about? Use that same conversation about expected move to talk about volume profiles, to talk about short from above. Here's crude doing something similar. It's just about mean reversion. And once again, it's not about a whole bunch of words babbling about where you think the market's going to go. Not to be crude or crass, but it's not. You can babble for 2 hours. The market's going to, the market's going to, the market's going to, the market's going to. Okay, wonderful. Did you give me a target? No. Did you give me an entry point? No. Do you feel smarter having listened to that 3-hour discussion? The answer is yes. Yes, you do, because you're more informed. But even something like crude oil, right? Again, this is not necessarily expect the move, it's mean reversion. I can babble for 5 hours about this and that and Vlad, I call him my buddy Vladdy Putin. Vladdy over here is going to, blah, 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 in the Middle East, this and that, and inflation and tariffs and how that's going to affect the crude market. And I'm going to be really smart for having had those discussions and read a bunch of reports and, did a bunch of stuff. But I don't have a trade off of a bunch of 3 hours of analysis. And if you do, you do, but I don't. But I have something specific, an entry, a target, and something that will stop me out with a loss if I am incorrect in my plan. 6-5 down to 6-3. Well, woo doggies. Now, I'm being funny but I'm trying to get your attention because a lot of people get carried away in, say, a flashy analysis and fun conversations and entertainment. I'm talking the news channels, right? Not TheoTRADE, the news channels. You see a whole bunch of people get up there on Twitter and follow gurus. You see a whole bunch of breathless analysis on the TV channels. Does it make you money? You can answer it yes or no. Maybe it does. I don't play that game. I don't spend 5 hours trying to figure out where the market's going to go tomorrow. I spend maybe 30 minutes too. I still do that. I have the game plan, but my game plan is model specific, is price specific, it is trade specific. Entry here, target here. Oops, it didn't work, right? We got stopped out, next trade. Aha, that trade worked, right? So on and so forth. And expected moves. Here's the bond market too. So I don't know. I don't know where the bond market's going to go. I have a clue where the bond market's going. But I can tell you something. I gave zero. I had zero thoughts in my little brain here about where the crude market was going to go and where the bond market was going to go. I didn't know. Didn't read a thing. Here's what I did: threw a chart on, threw a number on there, and gave it in my report. Well, I'll be darned if what I said or what not I said. I'm the messenger. I'm not a magician. Just be clear. I'm not a magician. I'm not a magician. Not a crystal ball. I am somebody who assesses probability, looks at price levels, and makes determinations. Now, if you get the same thing, I think that's even if 3 hours of breathless analysis on the TV, let's say they were correct. You listened for 3 hours and you got short this and came out here and you made money. Or 5 minutes or reading my report or doing, 10 minutes doing it yourself. The outcome's the same, y'all, isn't it? The effort versus outcome here. I'd rather be correct with as little. I'm not talking. I'm talking. Mark Twain stuff here, which is a little bit, but not too much. Simple. Yeah, sorry, simple, but not too simple. Right. Anyway, expected moves fall in that category, and the like there. Okay. Other questions in the chat? MW said, why can't somebody say, are you do you I I I don't know what to say about that. Well, I'd flip the script. What do you not see about you know, I don't know, the model that argues that we're probably going to have the slow grind up, and it's not the president. It's not the chair Powell. I don't think he was president in 2016. He won, right? But he was president in 2017, but I don't know. I don't think he was president in the 100 years that we've had little slow grinding markets, or Chair Powell for that matter. I don't think either of them had anything to do with 2013 or 2014 for that matter, or so on and so forth. So again, I get it. Trust me, I get it. 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 But I just don't get the bearishness 24/7. I did when I first started, but now that I'm 25 years in the business, full-time professional trader since about 2006 after grad school, I've been a bear. I'm a bear when I need to be a bear, but I just don't get this constant, breathless, every single day is the top of the market. I just don't get that stuff. I really don't understand that. I guess in one point in my career, in my 20s, I did. But I'm in my 40s. I don't understand it. I bloody don't get it. I can't, y'all. I can't. 24/7 bear. But I'd say the same thing, 24/7 bull. I don't believe in 24/7 anything. Follow the price. We go through bear swings. We go through bear markets. And that was a bear market. That was a bear market. And believe it or not, that was a bear market. We have had three actual, meaning 20% declines, bear markets in the last few years. That's happened. And we've done, I think, really well to guide you through that here on TheoTRADE. But calling tops, while very important, or shifting your assessment is vital, losing sight of the big picture, I'd rather get them. I don't know. It's just I've done all kind of stuff. I was a bear here. I got my career started in the bear market. So I ultimately I had to shift in 2012. So I was riding the bear stuff up. I was bear to the hilt until about 2012. And I can tell you I have shifted that since 2013. Absolutely. So, and there have been bear markets along the way, but they are few and far between. They're real. They're powerful, but I just think, given our own devices, we should be bulls. We should be optimists. We should be expansionist. Um, Probably should leave it right there. Okay. Well, again, the bear, when it happens, you get a lot of money. So from professional traders, and I want to make the distinction from professional traders, bear is fine. Puts are fine. Things are professional. That's fine, because professionals can manage risk. They can hedge. They can do a lot of things. They have experience. They've been through, many good and many bad outcomes. They've lost money, and professionals are here through experience, not through anything magical in our brain. It's experience. So experience has taught, and Gianni's going to come on, which maybe take the ball and run from me, or run with me here. I just cannot comprehend 24/7 bearishness to a new and developing and early trader. Become a bear later in your life. Become a bull and stay a bull earlier. You're going to be happier, and I think things will be much better for you. Gianni, do you want to add to that?
Yes, I do want
Good.
to add that. I
What you
think.
got, my friend? Oh, wait there.
All right, cool. Yeah, so I don't know what happened. My camera there was acting funky. But
Uh-oh.
yeah, I actually want to double down on what you just said, Corey, because when I first started trading, I fell into the camp of gold bug, economic collapse, category, and I probably wasted a good 2 years being in that camp and fighting the tape and fighting the trend. And
Me too.
is that 2 years I could sit back and think, oh, if I had that back, I'd have this much more money. Sure, but that's not how we do things here. You just pick up and
Yeah.
move.
It's an experience. You learn from that, so you
Yeah.
be better in the future. We can't, as like I say, if you eat the chocolate cake, you can't, undo it. You have to exercise for hours and hours. If you take big losses, you can't get it back except through meticulous, consistency
Yeah.
over time. You get it back, you lose the calories, but
Yeah.
losing 10 grand is a lot easier than gaining 10 grand. It takes
Yeah.
a lot of experience and stability to do that. So eating a chocolate cake, oops, but
Yeah, right.
takes a lot of
Well, it's like that the economics principle of the sunk cost. We always use the
mhm.
analogy like you can't cry over spilt milk.
Yeah.
I'm not going to try and like drink milk off the floor, right?
Blech, just get some new milk. Blech.
Yeah,
What an
no
image. All right,
thanks.
thanks, Gianni. Take care, be safe,
All
and
right, thanks,
thanks, Theo
Corey.
Trade. We'll catch you all a little bit later, team.